Merdeka! 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 Merdeka!
It was on the date of 31st August 1957 that Malaysia gained its independence and liberalized itself from the control of their colonial master, the British Empire. Since then, it has been 62 years since the independence of our country, which has undergone many phases of development and liberalization in an effort to acquire the economic status that is now held by the former World War II participants of America, Japan, China, and Germany. In an effort to achieve this economic status, financial liberalization is said to be the catalyst which enabled these advancements. However, questions amid the solution appeared. What is financial liberalization?
The term financial liberalization is used to cover a broad set of measures such as the autonomy of the central bank from the government, the full freedom of finance to move into and out of the economy, which implies the full convertibility of a currency, an end to government-imposed differential interest rate schemes, and the abandonment of priority sector lending targets, and the complete freedom of banks to pursue profits unhindered by government directives, and it is also the removal of restrictions on the ownership of banks, which means denationalization. However, in this video, we will only be focusing on the financial liberalization of the banking sector in Malaysia.
Financial liberalization will lead to the development of a more robust and efficient financial system. Such financial liberalization, however, is also accompanied by increased risks. For emerging economies, the net economic payoffs from such liberalization is therefore less clear. To fully realize its benefits, the associated potential risks of such financial liberalization need to be effectively managed. The financial infrastructure and intermediaries need to be sufficiently developed and managed so as to ensure its functioning in a more competitive financial system. Financial liberalization will increase efficiency in the financial intermediation process and will lead to a more efficient allocation of funds, therefore reducing the cost of the financial intermediation process. The increase in foreign participation in the domestic financial market will lead to increased market liquidity and more competitive pricing. Financial liberalization leads to the development and expansion of financial markets, particularly the debt-related markets, which is important in financing investment activity. Financial liberalization could amplify further the implications of financial stress from other parts of the world on the domestic financial system. Besides that, financial liberalization could amplify and accentuate asset bubbles and boom-bust cycles. Increased foreign shareholding in domestic institutions would in turn bring new expertise and best practices, which would enhance financial stability. To conclude, financial liberalization is unlikely to result in higher economic growth without a well-functioning financial system. To accelerate growth, the financial system needs to be properly developed and managed before undertaking any liberalization program.
Before the SAP Structural Adjustment Program, the financial sector of Pakistan was under tight control such that money, bonds and equity market were probably not in existence. So, interest rate was under control and commercial banks were owned by the state. Government decided to privatize the insurance company and state-owned banks. It liberalized the interest rate and strengthened the State Bank of Pakistan. The second phase of financial liberalization commenced in 1997 when the National Savings Scheme was restructured. Banks were privatized completely and more power was given to central bank to regulate the money market effectively.
India had inward-looking trade policies focusing on import substitution, replacing trade import with domestic production. protectionist policies for the trade sector were in existence to protect the domestic industries from external shocks in India. The trade policy of India was for intervention. It was inward-looking and major big industries were controlled by the states. During the mid-1980s, India shifted its strategy from import substitution toward export promotion and the trade liberalization program started. The process of liberalization of the financial sector started after accepting the SAP introduced by the IMF in the early 1990s. In 1991, India faced the balance of payment crisis, which forced it to go for more liberalization of its financial sector. To settle the macroeconomic imbalances, India moved towards accepting the IMF recommendations. It liberalized interest rate, reduced the cash reserve requirements, let capital account move freely, and allowed for competitive environment. Due to the banking sector reforms, the private sector credit to gross domestic product in 2007 rose to 55% from 30% in 1993.
Malaysia has a rich history of financial sector reforms. Since the 1970s, a series of financial restructuring programs that aim at improving the financial system had been launched. Immediately after the Asian financial crisis hit the country in 1997 to 98, a series of macroeconomic policy response such as capital controls and reflationary policy have taken place.
So, this was followed by restructuring in the corporate banking sector. Before a restriction on borrowing from abroad was put into place in 1995, many large organizations in Malaysia reported to foreign funds instead of relying on the domestic bank to fund their business expansion project. This suggests that the domestic banking sector have not been playing a vital role in the allocating resources. This is further supported by the finding of Jomo, which revealed that the Malaysian bank did not channel resources to the most productive use in the early 1990s. Most lending was issued for the purchase of share and real estate property rather than the investment in productive activities. This led to bubbles in the property sector and triggered much speculative activities in the share market prior to the financial crisis in 1997 and 1998. The overly risky behavior adopted by the domestic bank in their lending policy have caused mismanagement of assets and generated much larger non-performing loans compared to the foreign bank during the crisis period of 1997 and 1998. The liberalization measures announced today aims to strengthen Malaysia economic interlinkage with other economies and enhancing the role of the financial sector as a key enabler of economic growth.
And finally, fund managers are positive on Malaysia's planned liberalisation of its capital markets. This is in response to Prime Minister Datuk Seri Najib Razak's recent announcement on the proposed removal of mandatory requirements for credit ratings on bonds.
Najib also said foreign entities will be able to own 100% stakes in credit rating agencies and unit trust management companies in Malaysia. The fund manager said the measures would open up more choices for Malaysian investors and spur the development of more innovative financial products. Aberdeen Asset Management CEO Gerald Ambrose Johari Ali Abdullah said full ownership of unit trust management companies in Malaysia would allow foreign-owned fund management firms to obtain management licenses for conventional unit trusts. He said the removal of mandatory requirements for credit ratings on bonds would expand the local bond market. Meanwhile, Phillip Capital Malaysia Group Managing Director Andy Lim said the liberalisation measures would help more foreign funds to set up operations locally. The introduction of more financial products is seen timely as there is still a lot of room for the local unit trust sector to grow. Meanwhile, others had pointed out the need for independent financial planners to help investors construct the right portfolio, given that the liberalisation measures would increase the choices of unit trust funds in the market.
These liberalisation measures are consistent with the objective committed under the Financial Sector Master Plan (FSMP) issued in 2001 to develop a resilient, diversified and efficient financial sector. More than 90% of the FSMP initiatives have been completed or are being implemented on an ongoing basis. Domestic banks today are well capitalized with risk-weighted capital ratio (RWCR) of 12.5% and an average asset size of 91.6 billion.
Foreign-owned banking institutions have set foot in Malaysia since very long ago. In fact, the oldest bank in Malaysia was a foreign bank by the name of Standard Chartered Bank Malaysia Berhad. It was established in 1875 in Downing Street, Penang, to meet the financial requirements of the early European traders. Hence, it is a fact that Malaysia is no stranger to the financial liberalization process. Other major foreign banks followed suit as the strong prospects for growth in trade drew keen interest, making it vital for these banks to establish their presence in Malaysia. Since then, foreign banks have become major players with a significant contribution to the Malaysian economy. The market share of foreign banks in Malaysia, as of now, is approximately 27%. Malaysia has been positioned as a priority within the Asia-Pacific region by foreign banks, considering its growth potential and connectivity with other economies. Malaysia has always adopted an approach towards liberalization that takes into consideration the capacity and readiness of the financial sector to benefit from it, while promoting orderly growth and development of the financial sector in a liberalized environment. Greater foreign participation has been sequenced and managed, following the establishment of the necessary preconditions as articulated in the Financial Sector Master Plan 2001 to 2010. This indicates that if foreign banks intend to penetrate the Malaysian economy, the process for doing so is not a simple process. There are many prerequisites that need to be considered before licenses are issued out to foreign banks. This is consistent with Malaysia's aim to safeguard the stability of the financial system as mentioned in Malaysian Financial Blueprint 2011-2020. Although the Malaysian government prioritizes financial liberalization, local interests have to be protected as well. In this regard, efforts to strengthen the resilience and competitiveness of domestic financial institutions have led to the emergence of strong Malaysian-owned banking institutions with significantly improved performance indicators over the years. According to the Malaysian Financial Blueprint 2011 to 2020, Malaysia aims to enhance regional and international financial interlinkages. Malaysia expects that by liberalizing its financial sector, it will reap benefits in the form of foreign banks contributing towards growth of the Malaysian financial sector. The Financial Services Act 2013 and Islamic Financial Services Act 2013 further elaborate and provide greater transparency on the criteria for market entry by codifying the key expectations on the prudential soundness and quality of the value propositions put forward by prospective entrants, which are the foreign banks. These considerations are common across many countries that have liberalized and open financial systems, including developed economies.
To conclude, in order for financial liberalization to succeed, the prerequisites which govern the measures of financial liberalization must be strong. The prerequisites are stable macroeconomic environment and a complete and functioning financial system. Hence, in the case of Malaysia, the financial liberalization measures that have been implemented so far are quite successful, as the financial intermediation in Malaysia is quite effective. Furthermore, this is supported as domestic banks today are well capitalized and are able to operate on the same level with foreign banks. Thus, it is hoped that through financial liberalization, our country, Malaysia, can reach new economic heights, spreading prosperity to its people.